we have good empirical evidence for what constitutes a good inflation hedge. And basically, it boils down to two asset classes. One is exposure to commodity prices through commodity futures, and the other one is farmland.
Welcome back to another edition of COVID-19 from Crisis to Creation here on Mentorit TV. I'm Patricia Falco-Becali, your host. I don't know about you, but I'm getting a little worried about this COVID-19 crisis that seems to be a pandemic that drags on. So why am I worried? Of course, it's a health crisis, so I'm worried from a health point of view, but I'm also worried about our economies because, yes, recession is something starting to creep in, and of course we do have all those stimulus programs. We've got the central banks pumping in money, we've got the fiscal stimulus, and all of that, of course, in order to get this economy back up going. However, let's just think a little bit further. What about inflation? Inflation, why is that an issue for me today? Well, simply because inflation really eats up your pocket wealth, your paper wealth. The purchasing power of your hard-earned money could just wither away with inflation. So I was just thinking, why not invite a great commodity trader, hedge fund manager, Alex Krainer, to the show. He's also written a book about, uncertain times and commodity trading in uncertain times, weathering uncertainty in commodity trading, generating sustainable profits through trend following is his book. Alex, so good to have you. We're going to also quickly touch on the book, but I think, Alex, the real question is here, how can we, investors, normal people on the street, really deal with the potential inflationary risk? What are the protection tools, hence the hedging tools? Welcome to the show.
Thank you, Patricia. That was a lovely introduction. I'm very privileged to join you and your viewers. And I think that inflation is one of the most important subjects that we can talk about these days, because I believe that inevitably it is coming. Since the COVID crisis, I think it became even more inevitable because the Federal Reserve has responded to the crisis by QE4, the quantitative easing that is now larger than the previous 4 quantitative easings combined. One thing that we know about history of inflation, and my qualification, I'll just add that for 8 years of my career, I ran a hedge fund that was called Altana Inflation Trends Fund. So inflation was my target event. It was a tail risk strategy. And over those 8 years, I think that if there was an article published with the word inflation in it, I read it. So I went over everything. This is not to say that I have final and complete knowledge about the phenomenon, because the one unnerving thing about inflation is that generally we're always guessing. Nobody really knows anything, because one important ingredient to the whole mix is human psychology and confidence in the existing monetary arrangement.
Okay, and I think we will talk about human psychology and trading and generating trends in general a little later on. But let's stay a moment with inflation, because I'm looking at a couple of very interesting markets that could indicate one direction the economy could take and another direction the economy could take. And that is gold and oil, Alex. I look at gold. Gold, for me, for anybody, really has a safe haven standard that if inflation is coming, eating up your paper money's value, then, of course, you have gold. So gold has been going up, had a nice little rally the last 2 years, and especially also this year, really outperforming, for example, oil. Now, oil tends to go down if there is no inflationary pressure, simply because there is no economic growth. So production side won't have to have any fuel in order to produce. Why is this decoupling? What is the real story? Why is Greenspan? Why are you so convinced that we are really going to see an inflation? Also, if I may add, Alex, considering that after the financial crisis in 2008, inflation was a problem, yes, but not because it was there.
Well, the circumstances have changed. You know, the monetary authorities, not just the Federal Reserve, but all of the major central banks have responded to the economic crisis the way they usually do, by conjuring more debt, more money, and generally ramping up the printing presses. We are now in completely unprecedented times, but we have enough historical precedents regarding inflation to know that. Well, for example, Peter Bernholz analyzed 29 historical episodes of hyperinflation, 28 of which happened in the 20th century. And what he found was that pretty much when the central bank starts monetizing a significant proportion of government deficit spending, usually what follows is very high rates of inflation. We also know that since 1960 onwards, more than 2/3 of all market economies have sustained high rates of inflation of at least 25% or more. And the danger with this is that investors, people who depend on their savings, on their pension accounts and so forth, take very, very large hits on the purchasing power of their savings, which is half or more.
Alex, the inflation question is in my head simply because, yes, it is a statistic and you send it through to me, and it's wonderful that you say, hey, inflation is a real issue here and it really touches everybody, Joe Blogs on the street. But then again, the pickup of the economy might not be so certain. So you're saying the central banks are printing not only for economic recovery, but also they need to get rid of their deficits, which will not be done by economic growth. On top of that, it seems also that these stimulus packages coming through from the fiscal side, from the governments pumping in money, adds to that potential risk. And let me just quickly share, if I may, a screen with you. There you are. It's German. Some of my research is popping up in German because it comes through from Credit Suisse and sometimes from UBS. And it just shows you what we've seen as of monetary or money supply, money being pumped in to the economy. Let me just show you a couple of things. And Alex, if you would be so kind to just comment on it. So here, for example, that's the financial crisis of 2008. So money supply went up to a certain extent. Okay, then we had another economic wobble. Money supplies goes up, but it doesn't come back down to the original level. And now we are here. We are here, and money supply. I'm going to stop sharing now. Money supply always connotates that you will have too much money in the economy to be really keeping prices stable. Do you agree with that? And what can central banks really do in the long term to suck up this money again once the economy is going?
There are two types of inflation. One is let's call it benign kind of inflation that comes through with economic growth. So, like as the population in a given economy grows more prosperous, they buy more consumer goods, and so the prices of consumer goods go up. What we're talking about here is not this kind of inflation. We're talking about inflation that comes as a result of deflation. All right. So what deflation does, and this is what we've had in a very, very sharp, quick episode recently, is that it puts a very serious constraint on supply. So we had oil prices drop. We'll get to the oil prices later because it's another immensely fascinating area. But we had oil prices decline by 70%. We had one day when they turned negative, actually. There were some transactions that were recorded at negative prices. This kind of thing is a heavy blow for oil producers. Most of the shale producers, no, all of the shale producers in the United States never turned a profit. So at prices at below $40 a barrel, they're just piling up losses. All that production could completely drop off the market, and so suddenly you have a supply crunch. But there's a lot more than that that meets the eye. So once you have a supply crunch, with the time delay, you might have a very sharp increase in prices of commodities without there even being any significant economic growth, which is called stagflation. And stagflation is usually what you have when you have very high inflation episodes.
Yeah, high inflation without real underlying growth. And I'm so happy, Alex, that you mentioned the oil price. And yes, why don't we just talk about that, considering you just mentioned it? Because everybody back on the 20th of April just started scratching their heads going, what do you mean? Oil price minus $37 US. How does that happen? What does this mean? Where does it come from? And you were also just saying there are many elements. Please explain to me, to the Mentorate TV community, what really happened, and what really the underlying message is if something like that happens in the market, in these kind of economic circumstances we find ourselves in now.
Well, unfortunately, I cannot not tell you what really happened. I can tell you what the narrative was. Basically, that there's so much oil, there's such a glut of oil. Storages were overflowing, and oil producers needed to urgently get rid of all that oil, so they were paying buyers to take it off their hands. To be very honest with you, Patricia, I am very skeptical of such stories. I would like to see these transactions, and I would like to see that money actually changed hands, because a lot of times, as you know, I started my career as an oil trader and an oil market analyst. So I go back almost 25 years closely following the oil markets. And what you find is very often that narrative is often woven out of half-truths, untruths, fantasies, hysteria, hype, and so forth. And so what comes through in the media is often events that are real, but they're over sensationalized. And I would like to know who exactly paid whom to lift oils off their hands, because oil is an asset. You know, like even if you had, let's say coffee or gold, would you pay somebody to take gold off of you, or a barge of coffee beans?
Not really. I'd keep my gold for myself, considering the way it's been going and expected to go. But I like what you're saying, Alex. It's really interesting. It's not the first time that I hear that people go like, huh, what an iffy situation, and what is coming through the media, even through those people that are experts and try to analyze and really give their take of the story. You think that narrative was different, and there was no real physical exchange. Is this what you're trying to say, of that oil on that day?
No, I'm not saying that there wasn't real physical exchange. I'm just saying that I've seen no evidence of it having happened. That's all I'm saying. So maybe it did happen, but I'm not aware of any real evidence. I'm only aware of the narrative. And narrative is so completely off the charts of everything that I've come to consider normal and part of the normal reality, that I have to be suspicious of it.
No, it's an interesting one. And, if I look at the expectations going forward, Alex, what oil could do, of course, we had that big crash in the oil market. Since then, it started to come back. And apparently, according to my Credit Suisse material, it should be doing really well, the WTI contract, until the end of the year. And going forward, it should be one of those outperforming assets. So circling back to what commodities can really try to hedge against inflationary pressure that might come. What would you say? How does oil stack up? How does gold stack up? What do you do as a commodity trader looking at hedging strategies in an uncertain economic future?
Well, basically, we have good empirical evidence for what constitutes a good inflation hedge. And basically, it boils down to two asset classes. One is exposure to commodity prices through commodity futures, and the other one is farmland. I think that common sense suggests that probably a good hedge is gold, silver, precious metals, basically. Empirical evidence is a bit more, how do you call it, less certain about this, because what tends to happen with gold is that it follows, but not leads, inflation pressure. Gold usually catches up with the rest of the commodity basket, but it's things like copper, iron, energy, agricultural commodities that appear to be the best inflation hedge. So I think that for investors who can, the most advisable inflation hedge based on empirical data would be to have exposure to a diversified portfolio of commodity futures. Second one is farmland. That's one of the assets that cannot be printed out of thin air and will always be worth something. And it's important to note that what many people think that stocks are a good hedge against inflation. That's not the case. Stocks tend to underperform during inflationary periods, and in a lot of cases they underperform very, very badly. And when you look at episodes of hyperinflation like you had in Zimbabwe, Venezuela, and Germany in the 1920s, you see that stock investors basically got wiped out.
Alex, trends. Now, in terms of also the trends showing us inflation one direction, and then commodity or hedging protecting us against inflation with commodity futures, another thing. What can you tell me how trend and the trend statistics that you have developed also with your company really help us in order to get some sort of direction and protection?
Experts tend to get forecasts wrong at least 50% of the time. So you cannot, well, okay, let's go back to January.
You've got a trend there too. I love that, Alex. So you've got a trend forecast being wrong, showing a certain trend, i.e. 50% wrong calls. So better just forget about the other 50%. I like that.
Well, and the problem with forecasting is that, like if it were always wrong, then you could bank on it, you could do the opposite and make money. But obviously that's not so easy either. So 50% of the time they're not wrong, and so it isn't that easy. But if we go back to January 2019, Reuters polled 1,000 oil market experts to forecast oil prices through 2023. The average forecast was between $65 and $70 per barrel. Not one of them has predicted that oil would drop by 70%, but that's what happened. If you go to the Energy Information Agency under U.S. Department of Energy, they collect oil price forecasts from the leading oil market analysts and institutions like Deutsche Bank, Alex Brown, and so forth. And if you follow their forecast, it's just so sad. They just
okay, all right. It is sad because it really is us consumers, non-institutional investors, of course, depend on the big names and those research analysts being hired. So I get your message. Let's go back to trends. How you, in your own system, how do you follow trends? What are the signals you're picking up in order to form a trend? What makes a trend? And right at the beginning of our conversation, Alex, you also mentioned human nature, psychology, and I wonder to what extent you can put metrics on human nature and psychology as well as a ingredient of trend setting.
Well, that's a perfect question. It's a complex issue because obviously you cannot come up with a definition of trend that would distinguish all trends from all non-trends. It's a fuzzy concept. So if you look at a price chart of anything, you see that some shapes, some price fluctuations, trajectories are better examples of trends than others. And so you have to make a judgment. Judgment is a complex thing, and it happens in the human brain. So 20 years ago, when I started research into it, I decided that, okay, so if human judgments can come up with with what we think is trend and what we think isn't trend, then that must mean that our brains is doing some kind of a trigonometry that we should be able to deconstruct and reverse engineer to write algorithms that would perform the equivalent function numerically. So that's what we did. So what I do is if I look at any given market, I run let's call it tens, hundreds of thousands of iterations to try to come up with a trend definition that over time can capture value from large-scale price events in a way that it makes money. It makes more money than it loses when there's no trend.
Alex, we have to wrap up our conversation. I think this was super insightful. And speaking of insights, I'm asking my guests, what are the main lessons you learned in your profession over the last few years that you would pick out and whisper to whoever comes next into your professional seat? As in, okay, listen, if I have learned anything in this business, if I have learned anything in my career, watch out for this, that, and the other. What would that be?
Oh dear. Well, I think that one of the most important lessons that I have learned in my career is that in order to generate investment gains over the long term, you have to be willing to take losses. Meaning, you implement a strategy today, a strategy might make sense long term, but you don't know what's going to happen next month or over the next 12 months. And so you have to be willing and able to sustain losses over a certain period. That entails that you have to be very careful about your risk management, meaning don't get in over your head so that when you do sustain those losses, you can sleep with it. You know, you can remain composed and calm and keep your strategy rather than getting scared of losses and then start chasing your tail, because that leads to unhappy endings. And empirically, you know, if you look at what all the retail brokers that in some jurisdictions, retail brokers are obliged to on their homepage put the proportion of their clients that lose money, and you find out that 76% between 70 and 76% of them lose money. That's a very important lesson to take home. Don't trade. Don't imagine that you can, by quickly jumping in and out of positions, getting exposure to this and that, taking profits and jumping out, that you'll get ahead. The odds are stacked very strongly against you. So think it through, have a strategy, and give yourself the cushion to be able to sustain losses until the conditions in the market redeem your strategy.
Well, that's excellent. That is a really good takeaway. It is because it's technical, but it's also very psychological. Alex, thank you so much for joining me here on Mentor.
It was my pleasure and a privilege. Greetings to your listeners, and I follow Mentor TV. I think you're tackling extremely important subjects. I hope you'll get a lot more viewership, because what's coming our way are going to be changes that are so big and so momentous that we need to put our minds together, think it through, and see where it's going, and hopefully influence the process for the better.
Thank you so much for your feedback, Alex. Thank you so much, for your super kind words. And to you, dear Mentor TV community, I hope you really enjoyed this conversation. I think there's a lot we can learn from Alex here. And please keep your comments coming in. Keep following me. Keep the thumbs up if you like it, and also, of course, subscribing. Thank you so much, and I see you soon in the next episode.
Bye-bye.